Hello, so thanks for joining us today. Today we're talking about bridging loans, but the exit side of it. Obviously, we've done many podcasts and videos, etc., around how to take out bridging loans and the cost, etc., involved with that. But what is really important is if you can take the bridging loan out, you have a clear strategy of how you're going to pay this loan off. So I'll just sort of go into the sort of presentation slides now. So the most common ways we see in which a bridging loan will be paid off is sale of property. It may well be you're looking to buy a property, going to refurbish it, and then you're going to sell the property. So very simple. This is what the goal is going to be. But most commonly as well, people want to retain the property and they want to refinance it. And when they put a buy-to-let mortgage in place, there's different types of buy-to-let mortgages. So you've got a standard buy-to-let mortgage, then you've got a HMO mortgage, a holiday-let mortgage, a semi-commercial mortgage, and a fully commercial mortgage. So we're going to go into detail about these different sort of exit strategies, what they are exactly, and hopefully this will be of help. So let's go into the first thing. So sale of property, and as I mentioned, you're buying the property, you're going to sell it. One of the things I'll just sort of be aware of here is sort of know who you're going to be selling the property to. So is your target audience a first-time buyer, a home mover, or do you think you'll be looking actually to sell the property to a landlord? Maybe you're going to be sort of the way in which you're going to be refurbishing the property could well be you're going to set it up as a HMO, for example. So just sort of know who you're going to be selling this property to, and then obviously renovate accordingly to who you think your target buyer is going to be. And it's certainly worth noting here that the average time frame from marketing your property to completion is around 25 weeks. I got this from a Zoopla website information page. So certainly the reason I'm mentioning that is when you take out your initial bridging loan, as much as the refurb will take you 3 months, for example, make sure you factor in plenty of time to actually sell the property. And we'll touch upon later, just in case if that does fall through. But what you do want to make sure is from the start you've got time on your side, as opposed to all of a sudden approaching the end of the bridging loan, which can incur extra costs. So we'll certainly come to that a bit more. Okay, so let's sort of go into now the different type of mortgages that we see for people and how they exit bridging loans. So you've got a standard buy-to-let mortgage. So this is typically a property is rented out to a single person, a couple, or a family on a standard AST, which stands for Assured Short Hold Tenancy Agreement. And this is typically for a term of 12 months at a time. And standard is 75% loan to value is what you get as standard. There are sometimes lenders offering maybe possibly 80%. Whether there's any 80% deals at the moment, I'm not too sure, but in the past there have been, but certainly 75% is sort of pretty standard in the market. The other type of mortgage is a HMO mortgage. So this is where a property is rented to multiple people. Now, these people are not family members, and the property is rented to typically three or more people. And ultimately, it's rented on a per room basis with shared facilities. So they'll share areas such as the kitchen or the bathroom. Okay. The lender that you go to will want to know what type of tenants will be in the property. Will they be students, for example, or will they be professional workers? Most HMO mortgage lenders allow up to sort of 6 rooms. But some more specialist lenders actually don't have any cap in place. So we can see HMOs for 10, 12 rooms, for example. So they're more specialist lenders that will cater for that. But most HMO lenders will go up to, say, 6 rooms as an example. Now, when it comes to valuing properties, majority of lenders will go by the bricks and mortar value on a property, and they will lend up to a percentage of that figure. So let's say, for example, they'll lend up to 75% of that bricks and mortar value. But one way in which you can really try to raise as much money as you can at the property is to use a commercial valuation. Now, some lenders, not many, but some lenders will go by the commercial valuation because you've got a lot of income coming in. Now, this really applies when you've got a HMO which has got 7 bedrooms or more. And now, because you've got a lot of rooms being rented out and because you therefore you've got a lot of rental income coming in, the commercial value can be more than the bricks and mortar value, and therefore you could raise a higher percentage against that commercial valuation. So you could possibly refinance and pull out a bit more money when compared to a bricks and mortar valuation. So that's certainly one thing to look out for. But say it is typically for 7 bedrooms or more, and you have to be an experienced landlord really to sort of qualify for that. So the next type of mortgage is a holiday let mortgage. So this is when property is rented out for a short period of time only. So typically like weekends or weeks to different people. So, places like Airbnb, for example. Now, from a lending point of view, we're going to want to know the possible rental income that you can achieve in the low, the mid, and the high season. And throughout the year, what will the occupancy rate be? So, i.e., how many weeks of the year do you think you'll be able to rent the property out for? These sort of figures are quite key to determine how much you could borrow and what the affordability would be for any mortgage. But typically, looking up to about 75% loan to value, providing obviously there's suitable rental income coverage in place. So now we're going to step into more the sort of commercial areas. So the first one is semi-commercial mortgages. So this is a property which has got both residential and commercial elements. So let's say, for example, you've got an office downstairs on the ground floor, and then you've got a 2 bedroom upstairs. So typically, both parts of this property have their own access, and you have different tenants in place. You have a commercial lease normally for the commercial element, and then you have a standard tenancy agreement for the flat above. So this is what you class as a semi-commercial mortgage, and you can typically get up to 75% of the property value on these type of properties, providing again there's rental coverage is enough. And then finally, you've got the full commercial mortgage. So this is on a type of property which is completely for business use and has no residential element at all, really. So, for example, you're looking at industrial warehouses, office blocks, mechanics as examples, really. Now, typically, um, the business that's leasing the space, there is a lease in place, generally for several years at a time. When I go back to a buy-to-let mortgage, they're sort of typically 12 months at a time. When it comes to commercial leases, these can be a lot longer, 3, 5, even 10 years long. And say the way these leases are written up, they're very different, sorry, when compared to residential tenancy agreements. As I mentioned, longer term, but also when it comes to things like repairs and wear and tear costs, etc., they can come down to the person that's renting the commercial space. Um, Whereas on residential tenancy agreements, the landlord will pick up the bill, but not on commercial. On commercials, it can be very much down to the tenant to pick up the cost of any sort of wear and tears on these commercial leases. But you can get up to sort of 75% of the sort of property value, again, depending upon sort of rental coverage that you're getting. So now to what I sort of talk about here, like if you get towards the end of your bridging loan, um, but the exit is not quite in place. So let's just say, for example, you're refurbishing the property, you've had delays due to maybe labour issues, getting materials, etc., and you're approaching the end of your bridging deadline. So, firstly, what I'd always say is, be proactive, liaise with your broker, with your lender early, tell them what's going on. Is certainly a good thing to do. Each lender can approach this sort of differently, but in my experience, lenders have allowed the term to be extended, providing they can see a clear plan in place and that an exit is fairly near. Now, and in relation to the payments, if you've been rolling the monthly payments into the debt itself, which is what is the case on many types of bridging loans, the lender can allow you to keep rolling that, providing there is suitable equity that lender's comfortable with, or they may ask you to actually start making the monthly payments on it. Now, obviously, that's down to make sure you can afford that. But say, I've seen it where lenders are willing to extend the term. We've come to a solution on this. And obviously, but it's certainly worth noting that if you do need to extend the term, you also you're going to have to keep paying monthly interest for borrowing the money, and there could be additional administration costs to extend the loan as well. So just be sort of mindful of that. So going back to when taking a bridging loan out, I'd always say you're better off taking a longer term with the ability to redeem the loan early rather than pushing yourself quite tight on time and then having to go to the lender and ask for an extension. All right. So now I just want to really talk about sort of taxation. Now, when sort of speaking to clients, very much early on, we sort of say, have you had tax advice around the right way for yourself to purchase a property? So this could be whether you buy a property in your personal name or whether you set up a special purpose vehicle, SPV, limited company, or any other structure to buy a property in. The entity in which you buy a property will impact the tax you pay when earning money on such as the rental income. Over the last 4 or 5 years, this has become a lot more complex area. The taxation rules have changed quite a bit, so it's certainly worth speaking and get property tax advice. And the sort of key questions I would ask your property tax advisor is, obviously go through, should I do it in my personal name or company name, etc. But also ask questions like, capital gains tax. What's the difference in different entities when I go to maybe sell the property? When I get the rental income in, can I offset any mortgage interest relief? Is that possible at all? And how the calculations work? Again, wear and tear on the property, how does that work as well? From an accounting point of view, and what can you offset and what can't you offset, etc. So they're the sort of questions that I would certainly be asking your taxation advisor. Now, from a lending point of view, some lenders do personal name buy-to-let mortgages, some lenders do company name buy-to-lets, and some lenders do them both. So just be aware that different lenders will be suited, and obviously our job as a broker, is to go out and find the most suitable lender for yourself. Now, when it comes to limited company buy-to-let mortgages, typically the rates offered are higher when compared to personal name buy-to-let mortgages, and the arrangement fees as well are higher when compared to personal buy-to-let named mortgages. But say, depending upon the taxation position, the advice you get, it may well be better to go down the limited company route. I don't know. This is for, everyone's situation is completely different. So getting tax advice is so key, because once you buy the property, if you later realize possibly you've done it wrong, you can't just get out of it. You have to then actually would have to sell the property into a different entity that will incur more costs, etc. Another lot of stamp duty possibly. So I'll say just thoroughly sit down with your accountant with what you're proposing to do and work through which is the best way of doing it. And then you can set it up correctly from the start. So I just want to go through now just an idea of the sort of calculations that lenders do. Depending upon how you own the property, lender will lend you possibly different amounts of money. So here's just a rough example that I've sort of put together just to give you an idea. So if you had a personal name buy-to-let property and you're a basic rate taxpayer, a lender that I came across, they would want 125% rental coverage. So the rental income you receive has got to be more than 125% of the mortgage payment. And in this example here, I've done a rate of 5%. So what does this actually mean from a number point of view? What does this actually really mean? So to borrow £200,000 at a rate of 5%, the lender would want you to have a minimum rental income of £1,042 per month. Okay, so the mortgage payment will be quite a bit less than that, but they would want you to have a rental income of £1,042 per month. But if you're doing a buy-to-let mortgage in your personal name and you are a higher rate taxpayer, borrowing £200,000 at a rate of 5%, the lender would actually want you to have a rental income of £1,167. So you'd have to be getting more rental income to borrow the same amount of money if you're a higher rate taxpayer. So that's just an idea there of what your situation is, depends on how it can, really make a difference to the amount you can borrow. And then finally, my final example here is if you're looking to buy a property in a limited company, the calculation they would use is actually very similar to if you're a basic rate taxpayer. So, borrowing 200,000 at a rate of 5%, they would want a rental income of £1,042 per month. So I've just got some different calculations there. So different lenders do it differently. I've seen some lenders, rather than 140% rental coverage, they want maybe 145, even 160, I think, in some cases. Every lender is different. This is a lot more complex than what it ever used to be. But say, just want to get straight away, get that tax advice right from the tax advice correct to which entity to buy the property. Because you've got to bear in mind that you may be a basic rate taxpayer, but if you buy a property in your personal name, and then all of a sudden you've got a rental income coming in your personal name, would that then possibly push you into the higher rate tax bracket? It may well do. So again, get the tax advice, get it correct from the start, and then us as brokers, we can then go and find the right solution for you. All right. So that's just really an overview there of exit strategies that people use when taking out bridging loans. Hopefully that's been help. Us as a business, we do offer advice on mortgages. We also can help on commercial mortgages as well. All the products that I've mentioned here, we can certainly help with, and say we're a broker. And say, with any sort of borrowing, your capital's at risk if you do not keep to the terms of the agreement. But say, hopefully that's been helpful. And thanks for taking the time to watch the video with me.